Good morning.
Good
Today
morning, sir.
we're going to do credit policy document first, and then credit appraisal and approval memorandum. How to prepare the memorandum, the credit memorandum for the approval by the higher authorities of the bank. First, of course, we just go through the credit policy document. Credit policy document. All lending institutions should have their credit policy. The banks, finance companies, even leasing companies, all credit institutions who are involved in credit granting and recovering the credit should have their credit policy. That is laid down in the credit policy document. So this credit policy, it establishes guidelines and principles for a credit institution, credit risk strategies and policies. It aims to achieve a consistent, sound credit portfolio in the entire institution. And then desired credit growth while managing the risk. So you can just achieve the desired credit growth because the risk is there. So you have to manage the risk and achieve your credit growth. So that also the strategies will be there in the credit policy document. This is an important document for the credit institutions. One institution is different from the other. So the policy also different. There are so many banks, so many finance companies. So these institutions are not alike. So different from one another. So their credit policy document also will differ. Now, finance companies, small banks, and then development banks for development lending, and even big banks who are involved in corporate lending and in the almost all type of customers and granting all type of facilities. So these institutions, since they are differing, their credit policy also differ from one another. All credit policy documents aims sound credit portfolio without any NPEs. So all institutions, they are aiming through their credit policy that sound credit portfolio, they have to maintain a sound credit portfolio without any NPEs, non-performing advances. Preparation of the credit policy document. How the credit policy documents are prepared. So it is a written document for uniformity. In their institution, the uniformity should be maintained. So because of that one, this is a written document. Senior officers of the institution with extensive experience in credit management, they discuss, prepare the credit policy, and then circulate among other senior officers in the institution. If necessary, amend if necessary, and then finalize the credit policy document. So they will, the senior officers, a group or a committee, they finalize this credit policy document. Then it should be approved by the CEO or the GM and the board of directors. Then only it will be implemented. The credit policy document, finally, it should be approved by the general manager or the CEO and the board of directors. It should be flexible and updated periodically based on changes taken place. So it should be flexible, and then it should be, the credit policy document will be updated based on the changes taken place. That will be done through internal circulars, operating instruction circulars, or circular letters, like that. The internal circulars, this credit policy document will be updated periodically depending on the changes. What are the changes? Local, international regulations may change. Economic situation within the country may change. Risk appetite of the credit institution may change. Sometimes they show some aggressiveness in lending. Sometimes they show aggressiveness, how aggressive they are. So risk appetite of the credit institution, and then competition. Depending on this situation, the credit policy document of an institution may change. So the changes will be done by the higher authority of the bank and informed to the rest of the staff in the institution through internal circulars. Then credit policies. So what are the credit policies? It must be subject to direction of the Banking Act, Finance Act, and all relevant regulations. You all know the banking is governed by certain acts. Banking Act is an important thing. The case of finance company, Finance Act, and there are other relevant regulations are there. So the credit policy should be subject to directions of the Banking Act, Finance Act, and all relevant regulations. And then, more importantly, the direction issued by the Central Bank of Sri Lanka, IBSL, and internal norms are essential guidelines in formulating the credit policy. So when an institution formulates their credit policy, they will take into consideration all these aspects, all these relevant acts, and the central bank directions and regulations they will take. And financial institution may decide what is the maximum size of its loan portfolio, how much they can grant the facility based on its deposit base and the capital base and other factors. They will consider all these things, their capital base and the deposit base, and there are other relevant factors. Based on that one, they will decide what is the maximum credit portfolio that institution can go for. So these are the things included in the credit policy. There are other things also. Organization chart for the credit function. And each credit institution will have an organization chart for the credit function. Now, for the operation that we generally call it line management, there is a hierarchy will be there. Similarly, for the credit function in a credit institution, they will have an organization chart. Credit policy document will outline the organization chart relevant for the credit function. So, the credit policy document will outline what is the organization chart for the credit function. So, obviously, it starts from board of directors in the highest authority. Start from board of directors is the highest authority. Then, next to that one, there will be a board of credit committee. There is a credit committee comprising all senior managers, senior people of that institution who have extensive experience in the credit function. So, board of directors is the highest authority. And then there is a credit committee, we call it board of credit committee. Then the CEO or the GM. Then the DGM of credit, DGM credit. Then AGM credit, regional managers, area managers, and branch managers. It comes down. The hierarchy comes down in this way. Once again, the board of directors of the top, and then followed by there is a board of credit committee comprising so many senior DGMs, etc., etc. Then the CEO, DGM credit, AGMs, regional managers, area managers, and finally to the branch managers. This is the organization chart for the credit function in an institution. The function and responsibilities of these officers will be clearly described in this document. So this document, this credit policy document will give what are the responsibilities And what are the functions of these people in this credit line, in this organization chart of the credit function? In this organization chart of the credit function, various people are there at the different levels. So all their duties and the responsibilities will be given in the credit policy document. Then there is an important thing, delegation of authority. Delegation of authority. So authority is delegated to the different people. So authority of the credit functions delegated to the different people in the different levels. Each person involved in lending should know his or her authority limit to approve credit within the institution. It's an important thing. So each person who are in this credit hierarchy, this credit organization chart for the credit function, the people are there, they should know what is their lending limit, authority limit to approve credit within the institution. This authority is delegated according to a person's position within the organization hierarchy. Within the organization hierarchy. The credit policy document indicates authority of the board of directors. Yes, what is the authority of the board of directors? Authority delegated to the board credit committee, and an authority delegated to the CEO, GM, and other officers in the credit approving hierarchy. So all the people in this credit approving hierarchy, they will have their authority limit that is delegated to them by the institution, that is by the board of directors. They delegate to these officers in the credit function hierarchy. And apart from that, the amounts so delegated are reviewed annually. It will be reviewed annually. Sometimes it may be decrease or sometimes it may be increase to different people in the credit approving hierarchy. So these amounts delegated, this delegated amount should be reviewed annually. The GM or CEO of the institution will issue letters to the individuals of their credit authority limit. So this will be done by the CEO or the GM will issue letters to each person in the credit approving hierarchy. What is the authority limit? Based on their position, but also experience and the credit knowledge. Maybe sometimes some branches, the branch will have whoever come as the manager, their authority limited to the branch limit. That also there. Consequence of violation of delegated authority limit are described in the document. So if anybody violates this delegated authority limit in the credit approving hierarchy, if anybody violates their credit approving authority limit, then what are the consequences? That also described in the credit policy document. The deliberate violation of this authority will lead to disciplinary action. So if a branch manager's authority to approve 1 million rupees overdraft, temporary overdraft, if he violated, if he goes and approve maybe 1.5 million without obtaining any prior approval or even a covering approval, if he continues like that, that officer will be dealt severely. Disciplinary action will be taken against him. So violation is considered as really a bad thing. Consequence of violation of delegated authority limits are described in the document. The deliberate violation of this authority will lead to disciplinary action. procedures to be followed in exercising the authority, exceeding the authority in case of emergency. So that provision also there. Sometimes the managers can exceed the authority in case of emergency. In that case, obtaining covering approval are also included in the document. So once again we go, procedures to be followed in exercising the authority, exceeding the authority in case of emergency, obtaining covering approval are also included in the document. So if a manager, the branch manager, his authority is only 1 million to approve a facility, maybe a temporary overdraft, but the customer wants about 1.5 million. He can't approve it as per the credit policy document. He can't approve it. So he has to, with his recommendation, if he wants to grant that facility, with his recommendation, he has to send that, he has to request his higher authority, who has that approving authority for this 1.5 million. He has to, in case if he is not available there, he has to find out whether there are any other similar officer. In case if it is not there, urgent, the customer should be helped. The customer may be a good customer, okay, he can grant that facility, but immediately he has to obtain a covering approval. He must give the reason why he has done this, about the customer, what type of customer he is, why he has done this. By giving the reason, he has to obtain the covering approval from the higher authority, who has that authority to approve that limit. Procedure to be followed in exercising the authority, exceeding the authority in case of emergency, obtaining covering approval are also included in the document. Delegation of authority. Delegation of authority linked to collateral. So authority, delegation of authority also linked to collateral. For this type of collateral, how the delegated authority, that also there. Authority to allow credit without collateral are also included in the document, like TODs, temporary overdrafts. Authority to allow credit without collateral. So in the case of temporary overdraft, no collateral. So in that case, authority to allow credit without collateral also included in the document. So all these things are included in the credit policy document. Pricing policy in lending. So all aspects of credit facilities, granting credit facilities are considered, are included in the credit policy document. So pricing policy in lending. The lending institution should maintain a uniform pricing policy for lending to various customer segments in the entire institution, considering its cost of funds, administration cost, and risk factors. So the lending, the pricing policy, pricing of various credit products, the lending institution should maintain a uniform pricing policy for lending to various customer segments in the entire institution. So that is considered the pricing of the credit product. It's considered based of its cost of funds, then what is the administration cost, and what the risk factors. What are the risk factors? By considering all these aspects, cost of fund, administration cost, and what are the risk factors in lending, by considering that one, the institution price their credit products. So that will be a uniform one for the entire institution for various customer segments. So the lending institution should maintain the uniform pricing policy for lending to various customer segments in the entire institution, considering its cost of fund, administration cost, and the risk factors. Then there could be fixed rates or variable rates. The type of facilities subjected to these rates are also included in the document. You all know there are lending interest rates, there could be fixed rate, there could be floating rates or variable rates, and what are the type of facilities for which these rates are applicable. So all aspects are included in the credit policy document. Pricing can be linked to prime rates. You may know the prime rates. What is AWDR? Average weighted deposit rate, or AWPLR, average weighted prime lending rate. These rates are analyzed by the central bank, and weekly they publish in the papers. What are the AWDR, average weighted deposit rate? By considering the major commercial banks, what are their deposit rates for various deposits? What are their lending rates for various types of facilities? They analyze and they get this AWDR and AWPR, average weighted prime lending rate and average weighted deposit rate. So the pricing can be linked to prime rates also. That's also there in the credit policy document, or treasury bill rates. So this lending rate also can be linked to the treasury bill rates also. So pricing can be linked to prime rates, that is AWDR or AWPLR, or treasury bill rate. Those things are also included in the credit policy document. Pricing policy is clearly stated. When credit facilities are considered against the borrower's deposit with the institution, what is the rates applicable, lending rates applicable. Pricing policy is clearly stated when credit facilities are considered against the borrower's deposit with the institution, how much to charge. Maybe 1% above the deposit rate, or like that one. This is included in the credit policy. So when the bank is granting facility against the customer's deposit, so what is the rate applicable for lending? That also included in the credit policy document. Then the portfolio mix. An institution's loan portfolio can be mix of all sectors, or it can be limit the sectors it can advance within it. So the lending institution, the loan portfolio, if you analyze, it can be a mix of all sectors. Maybe for industrial sector, maybe for commercial sector, maybe for agricultural sector, maybe for import, maybe for export, maybe for SMEs, maybe for agriculture, that is group lending, for various sectors. It's a mix of the loan portfolio is a mix of various sectors. Like big banks, state banks, they have this mix. They lend to various sectors. On the other hand, there are some credit institutions, they limit their exposure only to certain sectors. Some banks, especially the international banks who have branches here, they consider mostly the consumer credit, personal loan facilities. Some other credit institution, lending institution, consider the trade finance, import and export. So their portfolio mainly the import and export, the trade finance sector. So others I have told you, their one is mainly consumer credit, personal loans like that. If you take the government state-owned banks in Sri Lanka, they have the mix. They have the mix almost all sectors. They will lend. So in deciding the sectoral exposure, institution will consider what are the regulatory guidelines. So in deciding the sectoral exposure, the institution will consider what are the regulatory guidelines they must consider. What are the priorities? What are the priorities? Then political authorities. How about political authorities? That is the state government. Then the geographical location of the institution. In certain area, mainly the agriculture. So there in that area, the exposure may be mostly for the agriculture. In certain areas, some branch, they have mostly the industries. So their exposure mainly for the industries. In certain areas, mainly import and export businesses, area like Colombo, Peta, these areas, mainly import and export. So their portfolio mainly consisting trade finance facilities. So in deciding the sectoral exposure, institution will consider what are the regulatory guidelines, then what are our priorities, then how about the political authorities, what do they want us, and geographical location of the institution or the branch, where it operates, based on that. Balanced portfolio. So you would have heard of balanced portfolio. This is also for quality lending, and institution should maintain a balanced portfolio. Portfolio mix is a tool to mitigate credit risks. Yeah, a balanced portfolio mix is a tool to control credit risk. So I always say, do not keep all eggs in one basket. If anything happens to that basket, NDA eggs will go for 6. So you have to keep the eggs in different baskets. Similarly, you must maintain a balanced portfolio. Major sectors considered in credit policy are, what are the major sectors considered in the credit policy? Commercial sector, then financial sector, agriculture, tourism, industrial and other manufacturing, housing, SMEs, consumptions, if sometime maybe usually others. So these are the major sectors. So this will be outlined in the credit policy document. Then the customer or market segment. So almost all banks, they of course have the segments. Customer segment or the market segment. For any business institution, they must identify what are their market segment. So similarly in the banking, the banks also have identified their customer segment or the market segment. So this document, credit policy document, will define the bank's market segments and the criteria for such segmentation. You can just segment customers also. Are these customers this way? You can't just segment. So what you must have some criteria for the market segmentation, customer segmentation. So what are the major market segments? Corporate customers, and then middle market customers, and then retail customers. These are the major market segmentation of the credit institution. Corporate segment, middle market, and retail customers. Criteria may be, so what are the criteria for this segmentation? Generally, in my lectures, I have already told annual turnover. What is annual turnover? Then, what is the total asset of that customer has? Then, number of employees working in that institution. So, based on that one, the banks identify their corporate customer segment, middle market segment, and the retail customer segment, they identify or segregate. They segregate this or segment these customers. So criteria may be annual turnover, total assets, number of employees. Different policy framework can be used for different segments. Yes. So the credit policy for these different segments, the institution, credit institution can have a different policy framework. In the case of corporate segment, corporate customer segment, they are the most profitable customers to the institution. So they may have a different policy framework. Similarly, for the middle market customers and the retail customers, the institution can have a different policy framework. Different policy framework can be used for different customer segments. The evaluation process, method of pricing, what is the interest rate chargeable for the corporate customer. So that is the method of pricing, and the collateral requirement also will be included. So in this different policy framework, for different customer segments, that include the evaluation process, how to evaluate their credit request, the method of pricing. So what about the charging the interest rates for the facilities they request, and the collateral requirement also will be included in the credit policy document. Then prohibited or discouraged credit facilities. All these things, what I am now telling you, already you have learned in the course of this program. These things, even most of the things I also have told. So most of the things, these things are there already. But now we are bringing everything together in the credit policy document. You have already learned all these things. So in the institution credit policy document, what things should be there. So now we are bringing what you have already learned into this credit policy document. An institution does not entertain certain type of credit facilities for various reasons, and that also included in the credit policy. So that also included some credit institution, they don't encourage, they don't entertain certain credit facilities for various reasons, and that also included in the credit policy documents. What are the credit facilities you don't entertain? Legal, cultural, religious reasons. There may be legal reasons, cultural reasons, religious reasons. For certain things you won't entertain. Certain credit facilities you won't entertain. Advance for illegal purposes. Illegal purposes you won't entertain. Manufacture and trading of narcotics, firearms, and that type of things. Not entertained. Facilities for that one, not entertained by the credit institution. And borrowers and guarantors listed as defaulters in the CRIP reports also come under this category. So that is also there. If any borrower, any customer is reported in the CRIP as a borrower or as a guarantor, will not be entertained. And the procedure to be followed in this situation also included in the credit policy. But if the institution thinks that type of customers also should be granted facilities, then what you have to do? What are the measures you have to take? So all these things are included in the credit policy document. As a general rule, the customers reported in the CRIP as a borrower or as a guarantor will not be entertained. But in case if they have to be assisted, then what is the procedure to be followed? There are procedures that also included in the credit policy document. Application of borrowers who do not provide required information as per bank's policy will be rejected. If the customer has come to bank for a facility, so bank wants certain information about the customer, about his business and other thing. If the customer is not prepared to give those information, that request of that customer will not be entertained, rejected. Applications of borrowers who do not provide required information as per bank's policy will be rejected. Minors and persons with unsound mind will also be in the category, and the procedures to be followed are included in the policy document. Generally, minors and the persons with unsound mind will not be entertained. But in case if you have to entertain, so what is the procedure you have to follow? That also in the credit policy document. Collateral and documentation. Collateral and documentation. This is a very important thing for a bank. Each type of credit facility and the collateral acceptable to the institution for such credit facilities and the procedures to be followed in each category are included in the credit policy. Purpose of granting short-term and term loans are also explained to safeguard the lender's interest and to ensure enforceability of collateral in case of default. So each type of credit facility, different type of credit facility, what are the collateral acceptable to the institution? So if it is a long-term credit facility, maybe a facility, the repayment period may be about 6, 7, or 8, or 9, 10 years. And what type of collateral customer has to use? Obviously, property, sound property mortgage has to be provided. The bank won't accept simple machinery, mortgage of machinery, so guarantors, bank won't accept because the long-term fund should be, the collateral should be also long-term in nature. So each type of credit facility and the collateral acceptable to the institution for such credit facility and the procedures to be followed in each category are included in the credit policy. Purpose of granting short-term and term loans are also explained to safeguard the lender's interest and to ensure enforceability of collateral in case of defaults. So the short-term loans or the term loan, for what type of facilities you can grant short-term or medium long-term loans, that also included in the credit policy. Then, how to obtain various types of securities or collaterals for credit facilities are included in the credit policy. How to obtain various types of securities or collateral for credit facilities are included in the credit policy. Cash deposits, you can accept. Government securities like treasury bills, treasury bonds, life insurance policies, then shares in quoted or unquoted companies, then stock in trade, then movable or immovable assets, then book debts, pledge, guarantees, and indemnities. These are the various types of securities. Banks accept. Back debt. These are the various types. So how to obtain various types of securities collateral for credit facilities are included in the credit. So this type of, when you are obtaining this type of securities or collateral, how to obtain, the details also included in the credit policy document. Then procedures to be followed for proper registration of mortgage bonds. When you take a mortgage bond, executing the mortgage bond, that should be registered, and the TR document, that should be registered, and the assignments are also included. Procedure to be followed for proper registration of mortgage bonds, TR documents, and assignments are also included. All these things you have learned by various lecturers have taught all these things. Now we are just bringing here to put it in the credit policy document. The credit policy document is giving all these information. It is included in the credit policy document. All other documents needed, such as letter of offer, agreements, bonds, are also indicated with legal requirements in the credit policy document. So All other documents needed, such as letter of power, agreements, bonds, are also indicated with the legal requirement about the collateral and the documentation. Then credit monitoring and follow-up. This is also important aspect. Procedures for credit monitoring and follow are included in the document. Procedures for credit monitoring and follow are also included in the document. Right, what? Periodical review of credit facilities. So credit facilities should be reviewed periodically. How the facility is going on? Are we allow that facility to continue? How the facility is going on? Periodic review of the credit facility. Then, necessity for customer visits. So you have to do customer visits. Necessity, whether it is necessary. In that case, how to do it? Customer visits. Necessity for customer visits. Obtaining periodic reports from the customer. So you have to obtain, if you decide, maybe depending on the risk factors and other things, you may decide to receive periodic reports from the customers. Periodic reports from the customer. Then how to identify deterioration of credit are also included. What are the signs? How to identify? You are granted a facility, there is a deterioration of the credit facility. How to identify? All these information are given in the credit policy document. Once again, periodical review of credit facilities. The credit facilities should be reviewed periodically. The necessity for customer visits. Why you have to visit the customer? Whether it is important. What is the necessity for you to visit the customer? Then obtaining periodic reports from the customer. How to identify deterioration of credit are also included in the credit policy document. Downgrading of customer rating and recovery procedures are outlined in the document. Okay, you are grading your customers, internal grading, risk rating, then downgrading of customer rating, downgrading the customer rating. And what is the procedure for recovery if the customers fail to repay? All these things also outlined in the credit policy document. If the credit facility is to be restructured, procedures to be followed. So there is a default on the side of customer credit facility. After analyzing and everything, having the discussion with the customer, you may decide to restructure the credit facility or reschedule the credit facility. So in that case, what are the procedures you have to follow? If the credit facility is to be restructured, procedures to be followed. What are the procedures to be followed? As well as delegated authority for such action are also included. Similarly, if an NPA to be rescheduled with a capital or interest waiver, the maximum amount or concession that can be allowed under each authority level and the procedure is also included. So in the case of restructuring or in the case of rescheduling an NPA, non-performing advance. So what are the procedures? And what is the delegated authority for that officer's concern? Also included. Once again, if the credit facility is to be restructured, procedures to be followed, as well as the delegated authority for such action is also included. In the case of NPA, if an NPA to be rescheduled with a capital or interest waiver, the maximum amount or the concession that can be allowed under each authority level and the procedure included. All these things you have learned in this program. Already you have learned. What are the procedures? How to reschedule a facility? How to restructure a credit facility? You have already learned. Then the person responsible for maintaining security document. Who is responsible for the security document in a credit institution, in a branch? Yes. And the person's role in safeguarding the institution's interest also included. The person responsible for maintaining security document and the person's role in safeguarding the institution interest is included. All these things you have already learned. So in a credit institution, these things are included in their credit policy document. Non-performing advances, NPAs. Procedure to identify NPAs and the action to be taken thereafter, and the accounting procedures are included in the credit policy document. Provisioning policy against NPAs, considering the period the credit facility was in default, also included, subject to regulatory requirements. Central bank regulations are there, subject to that one. Subject to the central bank regulations, the provisioning policy against NPAs, considering period the credit facility was in default, are also included, subject to regulatory requirements. So these things are there. Based on prevailing legal requirement, the procedure to be followed in instituting legal action against each collateral also explained how to institute legal action against each type of collateral in case of default based on the legal requirement. So this is also included in the credit policy document. How to file legal action against clean or unsecured facilities. So clean facility without any security. Unsecured, so without any security, maybe with the guarantors. Unsecured facilities. Unsecured facilities with collateral. And the responsibilities of relevant departments and units also explain how to file legal action against clean or unsecured facility and secured facility, and the responsibilities of relevant department and units also explained in the credit policy document. All these things the lecturers have done. You all know. Now we are informing you that these things are in your credit policy document of your bank, of your institution. Then procedures and approvals required for parate action and after auction also explained in the document. You have learned about parate action. So all these information, how to file action, procedures and approvals required for parate action. Procedures and approval from where you have to obtain the approval required for parate action. And after auction also explained in the document. If new facilities to be granted to a defaulted customer to revive the business, the procedure to be followed also included. In case of customers, defaulted customer, but you are thinking you have to assist him to revive his business. So what is the procedure to be adopted? That's also included in the credit policy document. And another important thing, the credit audit. There is a separate chapter in the document for credit audit, outlining credit audit requirements and its aims, how to do the credit audit, and what is the aim of credit audit. That also included in the credit policy document. It is required to ensure compliance with the credit policy and the regulatory requirements. Quality of credit granted, follow-up and supervision, skill level of credit personnel, and training needs are the scope of the credit audit. If an audit visits a branch doing the credit audit, they do the credit auditing, and then They will mention about quality of the credit granted, about the follow-up and supervision, and the skill level of credit personnel. They identify the credit personnel who are handling this credit, their skill level, and train CEO. They may recommend a training for that credit personnel, depending on how he is performing his duty. The credit audit people, credit audit may recommend training for that person. Training needs are the scope of the credit audit. Annual review of credit granted is an accepted policy of financial institutions, and the audit team verifies adhering to this requirement. Annual review of the credit granted by the branch is an accepted policy of financial institution. So, financial institution accepted policy, all the credits granted should be reviewed annually. So, the audit team, when they visit, they will check whether it is done, whether this is adhered to this requirement, whether branches or the credit people have adhered to this requirement. They will do it. In the risk management, credit risk management. Credit risk management procedure of the lending institution is an important part of the credit policy document. So the credit policy document describes credit risk management, how to do the credit risk management procedure. So it is a duty of the risk management team to ensure that the bank maintains diversified and quality loan portfolio to the bank. So it is a duty of the risk management team to ensure that the bank maintains diversified and quality loan portfolio to the bank. Accordingly, the duties and responsibilities of the risk management department of the bank in controlling the credit risks of institutions are included in the policy. So each credit institution, they have a credit risk management department, risk management department. So the duties and responsibilities of the risk management department in controlling the credit risk of the institution also included in the policy. Word of advice to the credit officers. So we have discussed what are the salient features, what are the things included in the credit policy document, the importance of credit policy document. Now, so what the credit officers should do, all the officers involved in lending operations within an institution must thoroughly review the credit policy document approved by the board of directors of the institution and understand all the guidelines comprehensively and be familiar with this document. This is an important thing. Some time back, I used to do my lectures on credit culture. There is strong culture, weak culture. We were discussing strong culture, weak culture. If almost all the credit officers of the institution are familiar with this credit policy document, they know, then they can maintain a strong credit culture in the institution. If they don't know what is in the credit policy document, obviously that institution will have a weak credit culture. For the sound operation of the success of the credit institution, adhering to their credit policy is very, very important by the credit officers. So the credit officers should know, all officers involved in lending operations within an institution must thoroughly review the credit policy document approved by the board of directors of the institution and understand all the guidelines comprehensively and be familiar with this document. If it is so, in this case, can maintain a strong credit culture, the institution. Ignorance of the credit policy is detrimental to the organization, as any deviation can result in serious violation of the law of the country or regulation issued by the regulator, the central bank. Ignorance of the credit policy is bad, is detrimental to the organization. Weak credit culture, as any deviation can result in serious violation of the law of the country or regulation issued by the regulator. Besides, the lending institution will be unable to recover credit facilities due to the negligence of the credit officer as a result of violating the credit policy. In the bank, the negligence is a very serious offense. Negligence of duties is a serious offense. So besides, the lending institution will be unable to recover the credit facilities due to the negligence of the credit officers, which is due to as a result of violating the credit policy without knowing the credit policy. If the credit officer performs his function, then it will be a failure. It is detrimental to the credit institution itself. This is the credit policy document. So this is, of course, most of the things you have already done in this diploma program. Various lecturers have explained. So all these things are in your credit institution, credit policy document. So if you are working in a credit institution, you must, of course, you must be very familiar with your credit policy. All banks or credit institutions, they have their manual of operation. Manual of operation. So manual operation means various operations, maybe savings account operation, current accounts operation, various operations have been given in that one. Similarly, the credit policy document of the institution will how to perform the credit function within the institution. But I have discussed all these things are relevant to the successful credit operation, credit management. So in the respective credit institution, they have their credit policy document. So you should be familiar with that credit policy document, how to perform the credit function. Then you can have create a strong credit culture within the institution that will lead the success of your credit institution. Thank you. This is about the credit policy document. Now we move on to the preparation of credit appraisal and approval memorandum. Preparation of credit appraisal and approval memorandum. Credit appraisal process. This we have already learned. It may be a consumer credit or maybe a commercial credit or maybe a corporate credit or development credit. There is a credit appraisal process. So for that one, when a customer wants the facility, so we do the collection of data and information. That's also we have learned sources of information, how to collect various information. Then you analyze those data and do the credit appraisal. That also we have learned how to do the credit appraisal. And then you come to a conclusion, how to grant or decline. Whether to grant the facility. After doing the credit appraisal, you will decide whether to grant the facility or decline. If you are granting, then what you have to do, you have to do certain things. If you are decided to grant the facility, preparing project investment plan. So you must prepare the project investment plan. What and what things? How much to grant the investment plan. Then you will decide what is the equity of the customers and what is the debt, that is the bank debt. How much you are granting as the credit, the loan or the credit package, what is the equity the customer bring. Bring preparation of project investment. So if you decide to grant the facility, then the structuring suitable credit package for lending. So depending on the customer's need, what and what facilities you have to consider, you have to grant as a package. Structure a suitable credit package for lending. Then after that, you have to prepare. Preparation of credit appraisal memorandum. Preparation of credit appraisal memorandum. Then submit the memorandum to the relevant authority for approval based on the delegated authority hierarchy level. Based on the hierarchy level. What we have explained, what we have learned now. So, if you are analyzing, so this is credit appraisal process, collection of data and information. So, you have the sources of information which you have learned. You collect all these relevant data and information, analyze, and do the credit appraisal. Sometimes we call it credit evaluation. Those two words, appraisal and evaluation, interchangeably we are using. Credit appraisal. And then you come to a conclusion whether to grant or decline. If you decide to grant, then what you have to do, prepare a project investment plan for what and what things you are going to grant the facility. So in that case, what is a debt, what is a loan or other credit facilities, and what is the customer's equity contribution, equity. Then structure a suitable credit package. When you decide to grant the facilities, yes, structure what and what facilities you are going to grant as a package. Structure the package. Then you prepare a credit appraisal and approval memorandum for the hierarchy, highest authority, who has the delegated authority to approve this limit. Then submitting to the relevant authority for approval. So this is the credit appraisal process which you have to do. So preparation of an investment plan. Preparation of an investment plan. A simple example we take. We take a simple example. Preparation of a project investment plan. A simple example. A credit officer must thoroughly understand the project or corporate customer's requirement. So what the customer wants is requirement. After doing the appraisal, the credit officer must thoroughly understand what the customer wants. Then you prepare the project investment detail that will have debt and the equity. What is the amount the bank going to grant? what is the equity contribution from the customer. A simple example we have taken. The land, 25 million worth of land for the project. Maybe the customer is a company. They are in this Ayurvedic medicine, manufacturing and marketing business. Sometimes they are your customers. So now they want to expand their Ayurvedic medicine because depending on the situation, they think it is very conducive to manufacture and market Ayurvedic because of the various disease outbreak. People are moving towards Ayurvedic products. So the company also wanted to expand their production and marketing. So you also analyzing various aspects. You analyze and you also think, yes, it's maybe a good proposal. You can consider for granting. Okay, now the project investment detail you are preparing. What is the amount the bank can grant and what is the customer's equity. So customers, the land worth of 25 million, that is the customer's land. So that is customer's equity. Then the land development, they have to do some development, maybe clearing, leveling, then fencing of parapet wall building, then obtaining three-phase electricity, water supply, etc. Yes, so 5 million. That also borrower's equity. Then the factory building, they have to put the factory building, 35 million. Even Ayurvedic price, you have to maintain the hygiene level, very high hygiene level, Ayurvedic medicine preparation for the human consumption. Yes. So you have to factory building very clean and hygienic level should be very high. ISO standard should be obtained. So for that you have to maintain it. So the factory building, 35 million, bank facility. There may be other buildings, 15 million, that also bank building, bank facility. Then the machinery, they need a machinery to process and manufacture Ayurvedic preparations. Then 20 million, that is important machinery. Locally also they are purchasing some machinery, that is 10 million. Then they need some motor vehicles for the distribution. They are expanding the marketing also. So distribution and various other purposes, 15 million. Then they need working capital, 20 million. So by analyzing, the customers also would have given you also analyzing, you have decided, yes, this may be the investment detail. Total 145 million. Obviously, the customer would have given you a project report. Obviously, the customer would have given you a project report. In the project report, they have detailed how to prepare a project report. The customer has to prepare it through some external consultant. And your duty to analyze the report and see whether it is considerable, whether you can consider the facility. So the customer included all these things in the project report. There may be an introduction. There may be the technology involved in this preparation of marketing, preparation of Ayurvedic products. And then what are the raw materials? What's the procedure for the preparation? Yes, that should be included in the project report. How to manufacture, production process, raw materials involved, and then the management of the company, and then marketing of the products, then the other human resource requirement, all these things in the project report. So by going through, you are extracting the relevant aspects in the project report. Finally, you have come to a conclusion, you can grant that facility. So based on that one, now you have prepared this investment detail. Yeah, what is the debt equity? What is the equity of the equity contribution from the customer? What is the debt? What is the bank finance? So all these in total 145 million. It is there. Preparation of project investment plan. So it is in detail. Debt equity. It is in detail. Item, bank finance, equity, and the total. The land, bank is 0 nil, equity contribution, that is 25 million, total 25. But we have earlier slide, but you have seen that is in this format, we have put it. Then land development, 5 million equity. Factory building, 35 million, the bank. Other buildings, 15 million, the bank. Machinery import, 20 million. And machinery local, 10 million. And motor vehicles, 15 million, bank. Working capital, 20 million. Total, 115 million, the bank. Customers' equity, 30. So the equity, debt equity ratio, 79.3 and 20.7. So it may be 79 is to 21. So we expect minimum equity contribution from a customer about 20%. So it is almost 20%. Minimum customers equity contribution 20%. So the credit officer has decided this can be by doing various other analysis. So project investment detail he has to prepare. He has prepared. Structuring a suitable credit package. Now, yes, it is there. Now he has to structure a suitable credit package. Various credit facilities are available from lending institution for the borrower. We have learned. They are discussed. What are the various credit facilities? Direct facilities, indirect facilities. In the direct facilities, loans, overdrafts, like that. The direct facilities. Indirect facilities, guarantees. So we have various credit facilities. Even pledge facilities, pledge loan, TR loans, revolving credit, packing credit, like that. Pre-shipment finance, post-shipment finance, and various types of guarantees and bonds. Various types of guarantees and bonds. Various types of credit facility a credit institution can grant to the customer. Out of those facilities, to match this customer's request, what are the facilities you are going to grant? The credit officer should select suitable credit facilities and structure credit package to fit the borrower's requirement. So this is structuring a suitable credit package for the customer. So in the case of consumer credit, personal loans, housing loan, it is straightforward. So if it is a consumer credit, customers may come and ask for a housing loan or for a personal loans, maybe car loan to purchase car or consumer durables. It's straightforward. One type of facility. In the case of small and medium business loan also, it may be. Yes. Yes. Well, in the case of small and medium business loans also, it may be straightforward or may be very simple. Small and medium business loan. They may ask for a permanent OD facility to meet their working capital request. Permanent OD facility. Or a hypothecation loan facility. Hypothecation loan facility. Hypothecation of stocks. Stocks. Hypothecate their stocks. Trading stock. And obtain a facility. It's simple. In the case of small and medium business loans. But in the case of project loans or corporate lending, proper credit structuring is very essential. And the credit officer should offer best appropriate credit products to match the customer's need. So it may include direct as well as indirect credit products. So if you put it in a nutshell, we can say in the case of consumer credit, it is straightforward. Maybe a housing loan or a personal loan or a car loan or a consumer durable facility. Straightforward. In the case of small and medium business loan also, it may be straightforward or maybe very simple. They may want a loan or medium term loan or a POD facility, permanent overdraft facility, or a hypothecation loan facility, right, like that. But in the case of corporate lending, it is, yes, proper credit structuring is very essential. And the credit officer should offer the best appropriate credit products to match the customer's need, corporate customer's need. It may include direct as well as indirect credit products. It is general rule that lending institutions expect the borrowers to use their contribution first. Yes. The borrower's contribution, that is the equity contribution. So it is a general rule that the lending institution expect the borrower should bring a minimum of 20% of the investment as their contribution. And they must use it first. So the bank expects the borrower should bring minimum 20% of the total investment cost as their contribution, equity contribution, and they must use it first. So in this case, land and land development in this example project. So that is about 20% of the total investment, and they have to do. So they must provide the land, and they must do with their fund, they must prepare the land suitable for this project. So let us assume that the example project to purchase local raw material, processing it, and market the product locally. So I have told you it is an Ayurvedic medicine, manufacturing, and marketing company. So in this simple example, we are assuming a company, Ayurvedic company, to purchase local raw material, processing it, and market the product locally. Hence, the bank facilities can be for based on the cash flow. So you will decide based on the cash flow. The bank facilities can be for construction of building. So this is generally long-term credit facility should be provided to match the construction of buildings. So based on the cash flow, the long-term facility. Then purchase of machinery for the processing, local as well as imported machinery. So this is of course medium-term facility. Can be granted, medium-term facility. Then the purchase of motor vehicles, medium-term facility, medium-term loan facility. Then the working capital requirement, working capital. You can grant a loan, or a permanent overdraft facility. Permanent overdraft facility. Must be that important that it is a permanent overdraft facility or a loan. So if it is a permanent overdraft facility, it is revolving. It is revolving. Purchase of, that is working capital. Then alternatively, lease facility to purchase machinery and vehicle also could be considered with the consent of the customer. So here we have considered to purchase the machineries, medium-term loan facility, purchase of motor vehicles, the credit officer think medium-term loan facility can be granted. But on the alternatively, you can provide a lease facility also to purchase the machinery locally and to purchase the motor vehicle. If the customer's consent is there, you can, instead of a loan facility, you can provide the lease facility. So these are the credit facilities to be included in the credit package. The credit officer decides. A simple example. So once again, construction of building, long-term credit facility, one facility. Purchase of machinery, medium-term loan facility. Then purchase of motor vehicles, medium-term loan facility. Working capital, permanent overdraft facility. So in the case of machinery and the vehicle, alternatively, you can consider the lease facility also if the customer is willing. So structuring the suitable credit package. So based on that one, a term loan facility for the construction of building rupees 50 million from the investment plan we have put it. Yeah, then the 50 million, a term loan facility. Then overdraft limit of 20 million, revolving. It is revolving. For working capital, repayable on demand. That means if anything goes wrong when the bank demand, he has to pay. Otherwise, he can enjoy that facility continuously. He can enjoy that, but it is revolving. It should be revolved. So in the case of overdraft, in the case of permanent overdraft, yeah, it is revolving, but the interest, monthly interest will be added on. So customer should see, the borrower should see, the interest should be set off, interest should be paid. Otherwise, what will happen? It will get accumulated. It is exceed overdraft limit. It is bad. And if it is not revolving, then we call it as if the interest also add on and it will increase. It will be a hardcore. The bank, they use the term hardcore overdraft. Hardcore. In that case, the bank will demand. So repayment on demand. So letter of credit facility, right. Then overdraft limit 20 million, revolving for working capital, repayable on demand. Then letter of credit facility, LC facility, because this customer has to import the machine, import the machinery worth of value of 20 million. So it can be site, or this also you have learned the LC, site or term LC, you have learned under your international one. Right. So term letter of credit facility, it may be site or term, limit of 20 million to import machinery. But in this case, we are going to give the site LC. Right. Medium term loan of rupees 20 million to retire the import bills. So now import bills, that is letter of credit, that has to be paid. So for that one, we are granting, the bank is granting import medium term loan of rupees 20 million to retire the import bills. We use the term retiring import bill. On the LCs, the machine has come and the import bills have come. That should be paid. Then only the document will be released and the customer can clear the goods from the custom. So to retire the bill, to pay the bill, to retire the bill, another facility, medium term loan of rupees 20 million to retire the import bills on machinery import. Then medium term loan of rupees 15 million to purchase machinery locally. It's a local purchase machinery. Then to purchase the vehicle, customer also given his consent for a lease facility or lease facility of rupees 15 million to purchase the motor vehicle. So this is the credit package. Very simple credit package for this facility, Ayurvedic company, to start to expand their production and marketing of Ayurvedic medicine. Very simple example. Then the credit appraisal and approving memorandum. So this, of course, the credit officer has done. He has done the appraisal. And of course, he decided to grant the facility. Then he has prepared an investment plan, where how much the customer's contribution, how much the bank can grant, then what are the type of facilities to match the customer's requirement. That also everything he has planned. The credit officer has planned. Now he has to prepare a credit appraisal and approving memorandum. He has to obtain the approval from the hierarchy based on the delegated authority. He has to obtain the approval for these facilities. After deciding the credit structure, the credit officer will prepare the credit appraisal and approving memorandum as per the format used by the credit institution. Right. Each credit institution, they will have a format for the credit appraisal or approving memorandum. For the submission, for the credit officer to submit to the hierarchy for the approval, for the credit approval, each institution has its own format for this purpose. Each credit institution uses own format to maintain uniformity within the institution. So all have. You take bankers alone, they have their own credit appraisal approving memorandum. People's Bank like that. Pan-Asia Bank like that. Sambat Bank has like that. So if you are working in a credit institution, or working in a bank, or in a finance company, kindly obtain the format. Credit appraisal approving memorandum of your credit institution and go through it. So what I am giving here is a general one I am giving you for you to understand. But in your credit institution, they will have a format for this credit appraisal and approving. Please obtain that copy and go through it. Right. So each credit institution uses own format to maintain uniformity, because within the institution there will be uniformity, whether it is south or north or east or west. The branches, all branches should maintain a uniform credit appraisal and approving memorandum. In the case of SME credit lines, all participating credit institutions use a common form. Now the SME credit lines, when foreign banks or foreign institutions grant a credit line to our country, then the treasury there will be a monitoring cell for this credit line. Through that one, that credit facility will be passed on. So they will the final approving authority for the credit facility. That is we call it refinancing. Each bank, we call it participating banks. On certain criteria, they select the participating banks for this credit line. Sometimes some banks may not be selected to participate in this credit line because of their poor credit performance. NBA, certain percentage of, if the NBA percentage is more than certain percentage, they won't be selected. So based on that one, the banks which can participate in this credit line, SME credit line, granted by some foreign banks or international institution for the development of SME sectors in this country, the banks which can be selected to participating institutions. That means they are the people, they will grant the facility. We call them participating credit institutions. So these participating credit institutions, they use a common form for the appraisal and approving of credit facilities under SME credit facility. They use a common format. So that's what in the case of SME credit lines, all participating credit institutions use a common form. Apart from that, the other credit facilities, each bank will have their own format for the appraisal and approving purposes. All relevant and basic information should be incorporated in the memorandum to facilitate the approval process. All relevant and basic information should be incorporated in the memorandum to facilitate the approval process. And as approving authority, make credit decisions based on the information provided in the memorandum. It should be brief, concise, and provide all required facts and figures. So, the credit appraisal and approving memorandum should give all relevant information, and that should be brief and concise and provide the required facts and figures. The approving authority, the delegated authority in the credit approving hierarchy, must look at the project through this appraisal and approving memorandum. So it should be visible to him. He won't not personally go and see. Through your memorandum, credit appraisal and approving memorandum, through that memorandum, he must view that project. So in such a way, your credit appraisal and approving memorandum should give all relevant facts, and that should be brief, easily understandable, and concise. Unwanted things should not be included in the credit proposal, credit appraisal and approval memorandum. The credit officer should provide only relevant information and facts. If you go through your syllabus, it is said, and finally, the participants of this credit program, diploma in credit management program, and finally, they should be able to prepare a sound appraisal and approving memorandum. They should be able to prepare a sound appraisal and approving credit memorandum for their hierarchy credit approval. Finally, that is the aim. You should be knowledgeable in credit functions, credit management function. You should be knowledgeable, and also you should be in a position to prepare a sound credit appraisal and approving memorandum in your institution. That is the aim, finally. That is mentioned in your syllabus, credit management syllabus. So credit officer should provide only relevant information and the facts. Credit appraisal and approving memorandum. So it should consist the following. The credit appraisal and approving memorandum should consist the following. One is credit limit summary. Credit limit summary. Then basic information sheet about the applicant and the applicant company and the associate concerned and their relationship. Applicant company, and there may be subsidiary or associate companies. Yes. Then the insurance about this project. Then the credit officer's request, what the credit officer wants from the hierarchy approving authority request. Then he gives the background of the project, current status, competition faced by the company, and its strength, key persons in the management. Then financial conditions, that is profitability, liquidity, leverage, debt, interest cover, and comments under each item, financial. Then evaluation of collateral and its suitability. Then the profitability to the bank. Then risk analysis and risk mitigation factors. Then the special conditions. And finally, the recommendation of the credit officer. All these things should be included in the credit appraisal and approving memorandum in concise form or relevant facts. Facts and information should be given. So these are the contents of the credit appraisal and approving memorandum. One word of advice. In the banking sector, telling a lie is a serious offense. Similarly, hiding a fact also a serious offense. Disciplinary action can be taken if it is found. Telling a lie also serious offense. Similarly, hiding a fact. Hiding a fact also serious offense. So in the credit appraisal and approving memorandum, as good credit officers, you must keep that in your mind. So these are the contents of the credit appraisal and approving memorandum. Okay, now we pass on to the other one. Before that, we will have about 15 minutes break. Now the time is 10:40. Time is 10:40. We will meet by 15 minutes, 10:55. We will meet by 10:55. Okay, thank you. Right. Okay, let us continue now. Let us continue now. See, all these things I have already explained to you. This is a presentation mode. We have changed that from the presentation mode. Already we have explained all these things. Preparation of project investment plan, a simple example, and investment detail, bank and equity contribution, structuring a suitable credit package for this customer, structuring a suitable credit package. I have explained all these things. What are the facilities? And I have explained structuring a suitable credit package. Credit appraisal and approving memorandum. So the importance of this credit appraisal and approving memorandum. Once again, I can go through. After deciding the credit structure and the credit officer and credit structure, the credit officer will prepare the credit appraisal and approving memorandum as per the format used by the credit institution. Each credit institution uses own format to maintain uniformity within the institution. In case of SME credit lines, all participating credit institutions use a common form. Or relevant and basic information should be incorporated in the memorandum to facilitate the approval process. As approving authority, make credit decision based on the information provided in the memorandum. It should be brief, concise, and provide all the required facts and the figures. Once again, I have told you, once again, the approving authority sees the project through your memorandum. Appraisal and approving memorandum. Through that memorandum, he sees the project. So, in such a way, you must give all the relevant facts and figures which are relevant. You have to give all these relevant facts and figures about the project in the appraisal and approving memorandum. So the approving memorandum, appraisal and approving memorandum should consist these things. One is a credit limit summary, basic information sheet that is about applicant, associate, concern and their relationship, and then insurance, and then the request. Then the background, current status, competition faced by the company and its strength, key persons in the management, then the financial condition that includes profitability, liquidity, leverage, debt, interest cover, and comments under each item. Evaluation of collateral and its suitability. Profitability to the bank, then the risk analysis, risk mitigation factors, then the special conditions, and finally, recommendation you have to give. Finally, the recommendation. So this your memorandum, appraisal and approving memorandum should consist in a very concise all the relevant important facts. Credit appraisal limit summary. Go to limit summary. Credit appraisal and approval memorandum. Credit limit summary. So in the limit summary, there is item, reference item. First, of course, in the limit summary, credit limit summary, applicant, you have to give the applicant's name. Now, I kept it as blank. So the applicant name may be what company, ABC Company Limited or whatever it is, Ayurvedic Company Limited, whatever it is, and their registered address, and what is the branch of your bank, right? And proposal number, reference proposal number. So your branch, you may be sending so many proposals in that order. What is this number? And maybe you can include the year 2022 the proposal number. This is about maybe 10 or 15 proposal you are sending, that one. So reference proposal number. Then the risk rating. So internal risk rating, you have to do it about the customer when granting a facility, or in the course of after granting also, or when reviewing, you have to do it periodically. Risk rating, you have to do it. This also, yes, we have done it. I have done it to you all. So risk rating, what is the risk rating? And what was the date? The risk rating done. And renewal date, when it should be done again. Renewal date. These things you must give. Once again, applicant, name of the applicant. Here, of course, I didn't fill it, that I kept it as blank. Address, I have kept it as blank. You have to fill it. Then branch, yes, what is a branch? Reference proposal number, you have to give. Risk rating, date, what date it was done, then the renewal. So then reference, facility reference, type of the facility, present limit, then outstanding, right? So all these in thousands, present limit also, that is you have to say it is in 1,000 rupees. Then the proposed limit, then funded or non-funded, whether it is a funded facility or the non-funded facility. Then interest and commission, what is a, if it is interest, what is the interest rate? If it is commission, what is it? Purpose of facility. And then security and repayment terms you have to give. So now, here in this one, note 1, facility reference note 1. Actually, when you prepare this limit summary, it is an important thing. So I think, so first looking at it, the approving authority can see, yeah, what are the facilities the credit officer is recommending. So if it's a new customer, this is a new customer. If it is an old customer, he may be enjoying facilities. He may be enjoying the facility. So in that case, type of facility, present limit, there may be a, yeah, what is the present limit? It may be there. Out of that limit, what is the outstanding? You have to give. Instead of nil, you have to give that one. So then funded or non-funded, interest rate, all these things you have to give. So in this one, this is a proposed, a new one. So POD revolving first. First, of course, we start from the limit summary, the overdraft facilities, POD, overdraft facilities, then the trade finance facilities, and finally the loans. So in an order, you will prepare. So first, of course, you start with, if you are granting an overdraft facility, first you start with the start facility. And then the trade finance facilities, if there are any trade finance facility, you mention that one. And finally, the loan facilities you will be given in the limit summary, right? So it should be, the limit summary should be in such a way, it should be give all the relevant information to the approving authority. These are the facilities enjoyed currently, and these are the proposed facilities. In this case, there is no present limit or a proposed limit. If there are any present limits, then those information you have to include it. In addition, the proposed limit, you have to include. Right. So POD. Present limit nil. Then outstanding also nil because there is no present limit POD. Proposed limit 20 million. So this is 1000, so 20 million. It is funded. Direct or indirect facility. Funded or non-funded facility. So this is funded facility. Then the interest commission. Interest or commission. 12% per annum. But maybe they have just put some percentage. You can. So this is to meet permanent working capital. Purpose of facility to meet permanent working capital. Then what is the security and repayment? Mortgage over project assets. So project assets, you are taking the mortgage. So that also cover this overdraft facility. And the repayment on demand. That is, the customer will be allowed. It's a revolving. It is a revolving facility. It is mentioned POD revolving. Customer can go on. If there is default, then of course the bank can demand. At any time, bank can demand. So this is repayable on demand. Until such time, the customer can use this facility. Then the facility 2, letter of credit. Letter of credit. So here a trade finance facility is coming. Letter of credit. This is site. That is when it has to pay it immediately. If it is nuisance, then of course there may be a time period, but this is a site. And one-off. One-off means only once it will be used. Only once it will be used. Present limit nil, outstanding nil, proposed limit 20 million. We have put it within bracket because in the total you won't take this as the total facility because I will tell you later. Right. This is non-funded. This is non-funded. Letter of credit, non-funded. The commission 0.25%. Maybe the commission percentage may vary from bank to bank. So I put some for you to understand there's a commission. So this you will take it from your credit policy. What is a commission? Or the relevant circulars. What is a commission for this letter of credit facility when you are granting? This is to import machinery. This is to import machinery. So this customer will establish letter of credit against the supplier to supply the machinery. So security documents under bank control. So all the documents will be under the bank control. And joint and several guarantee of the directors. Joint and several guarantee of the directors. These are the security. And it is self-liquidating. When the items comes, then another facility will be given to retire the bills. To retire the bill, so it will be self-liquidating. Now, facility third facility, term loan. Present limit nil, outstanding nil, and proposed limit 20 million. It is loan, it is funded, 12% per annum. Why this facility? Purpose to retire the documents under facility 2. Now this 20 million will be taken for the addition. So the earlier one, if we take that one also, then it will be doubled. No. So because of that one, we don't take that one for the addition purpose. So term loan, now 20 million. Yes. To retire the documents under the facility 2 above. This is to retire the document. To pay for that facility is 20 million. So mortgage over project assets, that is security, mortgage over project assets, then 60 equated monthly installment of, this is based on the cash flow. Whether 60 installments or maybe less or more, based on the cash flow, how can he repay? You decide. So I have, for an example, I have mentioned 60 equated installment. EMI, equated monthly installment. EMI, equated installment. Of rupees, the amount, yes, we have to put the amount. After a grace period of 12 months. This is also based on the cash flow. If the cash flow says yes, we need 12 months to start to repay the facility, it is after the grace period of 12 months. So it is a term loan to retire the bill under import bills. Then facility 4, term loan, present limit nil, proposed outstanding nil, proposed 50 million, funded 12% interest, construction of buildings. There are factory building, other building, yes, construction of building 50 million. So security, mortgage over project assets, then 96 equated monthly installment, it's a long-term facility. So this also based on the cash flow, you have to decide. Based on the cash flow, you have to decide whether it is 96 or 80, whatever it is, yeah, based on the cash. So equated monthly installment, 96 equated monthly installments of rupees. You calculate and put it, what may be the amount. After the grace period of 12 months, this also based on the cash flow. The customer need 12 months grace period to start repayment. Then next one, term loan. Fifth item, nil, nil. Proposed, outstanding. Existing and outstanding, nil, nil. Proposed, 10 million. Funded, it's a loan, so it is funded, 12% per annum to purchase machinery locally. So the import machinery also there, local machinery also there, this purchase machinery local. Security, mortgage over project assets, 60 equated monthly installments of rupees such and such after a grace period of 12 months. So this detail you have to give. So these are the facilities. And then limit summary. And finally, 6, lease facility to purchase the vehicle. So present nil, present one, and the outstanding nil, and proposed facility 15 million. Funded 12% per annum to purchase motor vehicle. Here the security, absolute ownership of the vehicle. Absolute ownership of the vehicle. So under leasing, it is absolute ownership is with the bank, lending institution. And monthly rental of rupees such and such. And the period of, you have to mention the period. So it is not mentioned there. You have to mention what is the period, monthly rental. And you total 115 million. So in this total, that letter of credit facility 20 million within bracket not included. So 115 million total the facility. Then in that one limit summary, you have to mention the CRIP status. What the CRIP says. It is clear reports, directors are clear, company is clear. So if it is so, if anybody is then reported, then that has to be included there. And what is the procedure mentioned in the credit policy document. If the facility is granted to a defaulted or CRIP mentioned borrower or the guarantor, that procedure you have to. Then the preconditions. There may be some precondition you have to mention in the credit limit summary. Credit facilities will be released after obtaining. Credit facilities will be released after obtaining duly signed letter of offer. Bank will issue the letter of offer. Customer should accept and sign the letter of offer. So duly signed letter of offer. Completion of security document. In certain cases, security documents are not completed, just obtained in the signature and grant, and it will be there. When there is any legal the procedure, then it will be a big problem. So you have to obtain, you have to complete the security documentation before granting the facility. Necessary approvals of local authorities, central environmental authorities, and necessary insurance cover over building, machinery, vehicles, and stock should be obtained. So these are the preconditions you mentioned under the limit summary. So this is the limit summary. A very simple example. It's a very simple example. So if it is Trade finance facility, if you want to import raw material, yeah, it will be revolving. So you have to provide maybe with a letter of guarantee, letter of credit, so revolving letter of credit, and each time to retire the bills, you have to provide the revolving credit facility, hypothecation loan, or a import loan, or a trust receipt facility to retire the bills. Those things you have to mention in the limit summary. Sometimes for the export, so that also, yes, you have to packing credit facilities, bill discounting, bill purchasing facilities, you have to mention. It has to come under this limit summary. This, of course, on your own, you have to learn on your own in regard to international facility, international trade facilities, yes. But things, yes. In such a way, you have to include in this limit summary if you are granting those facilities. So on your own, you have to practice and learn. Right. Credit limit summary. Right. Next one. Next item, you have to include in your credit appraisal and approving memorandum basic information sheet. Basic information sheet. So in the basic information sheet, you will include about the first you include the applicant. About the applicant. Constitution, first of course, constitution, whether it is a limited liability company or whatever the constitution, legal status, you have to mention. And then date incorporated or registered. So you have to give date incorporated or registered. Then the nature of business. I have told you this is a Ayurvedic medicine manufacturing and marketing company locally. So now the purpose is establishing a new plan to expand the production and market. Is a nature of business. Now, so nature of business is Ayurvedic medicine manufacturing and marketing. Then the account number, yes, you have to mention the account number. I have just put, so when you do it, of course, you have to give the account number. Date account open, yeah, I have given some date, you have to give. Check returns for in the last 6 months, nil. A good company. Foreign participation and percentage of shareholding, sometimes there may be a foreign participation. If it is there, you have to mention that one. In that case, what is their shareholding? You have to mention. If there are any foreign involvement participation in this project, in this business, and then account balances. Balance during past 6 months. Balance during past. Current account. If there is any debit balance, what is a maximum? What is a minimum? If there is credit balance, what is a maximum, what is a minimum. Then the average balance. Obviously, the system, computer system will give all these information. Those days, of course, it is manually. The officers have to calculate. Now, the system will give you the debit balance, if it is maximum, what is a minimum, maximum, credit balance, what is a maximum, minimum, average balance. Then balance of the accounts in the name of applicant at this or any other branch of the bank. The applicant means this company, Ayurvedic company. Balance of other account, if they have any other accounts in the name of applicant at this or any other branch of your company. So you have to give the information. The same information you have to give here also. Then the names of directors and their shareholding. Name of the directors, number of shares, value, percentage of issued capital. Percentage of issued capital. Now the shares in the companies, they have the authorized shares. What is the maximum capital authorized? And then to each shareholder, issued shares. How many shares issued? And then the paid up share out of the issued capital. How much the concerned director or the shareholder has paid? Very paid up share. So there are three things. One is authorized capital share, and the issued capital, and the paid up capital. So here, each director, you must give the number of directors, how many shares they are holding, what is the value of the share, and percentage of issued capital. What percentage they are holding out of the issued capital. What percentage they are holding out of the issued capital. Then facilities taken from other banks and financial institutions. From other banks, whether they have taken any institution, facility type, original amount, present outstanding, security, present position. What is that? So in this case, if they are not banking with any other bank, you may mention nil. You may mention nil. If they are banking with other bank, those information you have to give. Then the subsidiaries, associate, concern, and their relationship. So there are companies, they may have subsidiary companies, they may have associate companies, so they are concerned. Also, you have to give. Name of the subsidiaries or associate company. Details of facilities granted at this or other branch of this bank. Then whether there is any other bank. So name of the other bank. What is the facility type? Limit, outstanding, security, present position. If this company have they have their subsidiaries or associate, yes, from other banks or this bank, how much they have borrowed. Those details you have to give. So this is about the applicant, the information about the applicant. So these are the facts you have to give. You should not hide anything. You have to give the facts. You have to give. And then the insurance. You have to mention about the insurance, about this, about the facility you are going to give. Then asset insured, value of the policy, risk covered, valid till policy number. You have to. So one is factory building is, yes, that is 35 million. Both factory building and the other building, 35 million. So risk covered, fire, SRC, strike, riots and civil commotion, SRCC, strike, riots and civil commotion and floods. The risk covered. So against this risk, the policy will be obtained. Valid till it will be obtained after the approval only, that policy will be obtained. And the policy number will be given later. In the machinery, 30 million. That also same. Risk covered, fire, strike, riots and civil commotion and floods. To be obtained, policy number. In the motor vehicle, 15 million is a comprehensive policy. Comprehensive policy for the vehicles, it's a comprehensive policy. That also valid till and the policy number you will be taking. So these are the things about the insurance. So all these information you have to give for the approving authority to go through and make his decision. Right. Okay. Now we go to right here. Credit limit summary we have done. Basic information sheet. Yeah, about the applicant, the details we have given, we have to give. Associate concern and the relationship. Yeah, we have mentioned. Then the request. Sorry. Then the insurance. Yeah, that also that information we have given. Now the request. Now the credit manager has to make a credit officer has to make a request. So in the request, that we call it introduction or request. Right. So for what purpose the company wants this facility? For what purpose this company wants this facility? And about the industry, you have to mention something about the industry. How important this industry for the economy of the country? How important this industry is for the economy of the country? And why the importance to the economy? Then how the contribution of this industry to the economy, how the contribution. So that is one is employment creation, and in the health sector, it will provide assistance to the people. Employment creation. So what are the benefits of this industry for the economy of the country? You have to mention under this introduction or request. So here it is introduction and the request you have to make. Now here, of course, I have to tell you, you have to extract the relevant information from the project report. The customer would have given you the project report, and the project report you have analyzed. So the certain relevant information they would have given about the industry, about its contribution, and those factors. So those factors you have to extract from the project report, and you have the relevant factors. Relevant factors you have to present here. Extract the relevant information from the project report. Only salient features and how the total project will be financed. How the total project will be financed. That information you have already given, but you have to give now. You have to give how the total project will be financed. Then the raw material, necessary raw material. How the raw material will be purchased. Sometimes, in case if the raw materials are imported, but in this example, we didn't consider importation of raw material. In case if the raw materials are imported from what country, how, those details you have to mention under this request or introduction. Raw material, local imported items. Then the marketing plan. Then the marketing plan. How the company want to do the marketing. Then what are the marketing channels? What are the marketing strategies to market this product? All these information you have to mention in this request or introduction. The request for introduction you have to mention. And then there is an important thing, the request. Why this should be considered? Why this credit proposal should be considered? Under that one only, the importance of this project to the economy. you have to mention the important how this industry will be helpful to the economy, especially under the present situation. The importance of Ayurvedic product to keep the health of the people, and then the employment creation, then the quality of the products, all these things you have to mention in this case under request. Then the background, we move on to the background. Current status of the industry. Then competition faced by the company and its strength. Key persons in the management. These things you have to discuss under the background. Current status. So what is the current status of the Ayurvedic medicines? Current status of the Ayurvedic medicine. You have to mention that one. Maybe because of this pandemic situation, people are moving towards this Ayurvedic medicine because there are report proving the Ayurvedic medicines are very helpful to control this. Maybe you have to mention that one. Current status. And then competition faced by the company and its strengths. Yes. About the company's competition faced by the company. This also we have discussed competition in our lectures earlier, the competition of an industry competition, we have discussed. So from there, of course, with that knowledge, you should be able to competition faced by the company and its strength. So who are the competitors? There are so many other big Ayurvedic medicine manufacturing companies are there. So with them, this company also will compete. And apart from that, in provinces and where small Ayurvedic medicine manufacturing people are there, physicians are there. So they are also a competition. So how this company will face, what are the strengths this company has to face this competition? What are the strengths this company which you are proposing is having the strength to face this competition from the existing companies, Ayurvedic medicine manufacturing and marketing companies, and apart from that provincial level, small Ayurvedic doctors, Ayurvedic physicians, how you are going to compete with them. And then key persons in the management. Who are the key persons in the management? This is very, very important. I always stressing this is very, very important. Industry or a company, it has all positive. It can run very successfully. Market may be good, there may be good demand for the products, everything is good. But if the management is bad, the company will flop. That company will fail if the management. So the management is an important thing for the success of any company. You should keep it in view. So who are the key persons in the management? You must give their detail, their name, their age, their position in the company, their educational qualifications, and their experience. So all these things you have to mention the key persons in the management. You have to mention that one. So in the background, so now you have to explain the background. In the background, current status about the industry, that is Ayurvedic medicine manufacturing and marketing industry. What is the current status? And the relevant information you can extract from the project report. That is one. That is under the background. And then competition faced by the company and its strength. So how is the competition within the industry? Who are the competitors? So there, of course, you can, by forces also you can discuss. That is, in an important thing, you don't bring all the five forces aspect. No. So the 11 things you can. How is the buyer's effect? How is the supplier's effect? Whether there is any new arrival, whether there are any substitute, just can mention. The competition. And who are the competitors? And what is the strength this company has to face that competition? So all these things you can extract from their project report they would have given. They would have given. No, otherwise you have to discuss with them. You have to mention and you have to discuss with them and you can get those information and mention here. And then competition faced by the company and strength and finally key persons in the management. This is an important thing. Who run the business? The directors. In the case of company, the directors. Who are the directors? I have told you, the company may have very prospective future, but if the management is bad, the company will fail. Yes, that has happened. So the management, who are the management team, the name, their age, their position, their experience, their education qualifications, their commitment, you have to. And then in the appraisal and approving memorandum, the financial condition. Financial condition. This also you have learned very extensively in your program. Financial analysis. How to analysis, ratio analysis, horizontal analysis and vertical analysis you have done. So there you have seen profitability, liquidity, leverage, and debt interest cover. Debt and interest cover. Sorry, debt or interest cover. So this, you have to give this. How is the profitability? Various profitability ratio in a tabulated form you have to mention. In a tabulated form you have to mention profitability. Then the liquidity. Current ratio, asset ratio, you have to give liquidity. Then leverage. Then debt and interest cover ratio. So tabulated form you had to. And you had to give your observation and comment about the financial condition of these ratios. Your observation. The 11 things you had to give under this category. This, of course, you have learned extensively in this program under ratio analysis and everything. So you have to give in the appraisal and approval memorandum. And comments under each item. Comments under each item. You have to give. Right. And then another important aspect that comes in this appraisal approval memorandum, evaluation of collateral and its suitability. So what are the collateral you are taking? And its suitability. Here the mortgage of project assets you are taking. And describe the collateral. What are the collateral you are taking? Describe the collateral. So here the property mortgage. So just mortgage of property or something like that. No, you should not say like that. That is not enough. You must describe the property. Under evaluation of collateral, when you are taking properties as a security, as a collateral, you have to describe the property. So you can say, so if it is a land where the buildings and the project is going to be established, so that property will be, in this case, will be given as the security or the collateral, and you have to mention. So may say land, extent of this many purchase, situated in the lane or the road in Colombo 6 or Colombo 7. Depicted in plan. So you must tell about the plan. Plan number. Plan number. Number of the plan. And prepared by the licensed surveyor, his name. In lot number 304, whatever it is, lot. So when you take a survey plan, the name of the land will be mentioned. Then the land, that portion is shown as the lot number is given. That plan would have been prepared by a surveyor, licensed surveyor. There will be a date of the surveyor, date of the survey plan, extent of the land. So all these information you have to give. The land called, their old lands will have some name. Mahakanda Vatta or some Vatta, the land called, land named Vatta, extent of this many acres or purchase, situated in the address where it is situated, shown in plan number as lot number drawn by surveyor and the dated of the plan will be the mortgage. So you have to mention about the detail. And you have to describe about the property. You would have definitely gone and seen this property. So you can say this property, this land is situated in a commercial area or a very important area. The surrounding area, the values are very high. People are, this has a very valuable position. The land, everything you have to mention. And then you must give the value. Our panel value, these values of the land for the mortgage purposes, you obtain the valuers. You may have the panel of valuers. Each bank will have panel of valuers for this purpose, valuing the property. So panel valuer, his name mentioned, has given the market value of this property as such, this much. The for sale value of this property at this much. So for the land, there are three types of values. One is market value, other one is for sale value, and then insurance or reinstatement value. Market value, for sale value, and then insurance value or reinstatement value. Market value, when the property will be there, everybody knows this property is for the sale, and both buyer and seller with concern, they will purchase it under without any influence. Without any influence, it can be sold. So in that case, what is the market value? Then the for sale value, if the urgency arises, if we want to dispose this property immediately, what may be the value? That is a for sale value. Then the insurance value or reinstatement value. This is applicable if there is a building within the land. If there is a building in the land, then it will have a reinstatement value or the insurance value. That is, if anything happened to the building, to construct such similar building, how much money you needed. That is reinstatement value. So for that value, you have to insure the building. So that we call it reinstatement value or the insurance value. So all these things you have to give in the approving and approval memorandum when you describe the evaluation of collateral and its suitability. So just some people just say mortgage of property, something like that. No, you have to describe the mortgage, property by way of this. There are two survey plan, details given in the survey plan, name of the land, extent of the land, and what is the lot number of the land, and the survey plan, who has prepared the survey plan, and what is the date prepared, All these information. And then do observation about this land, where it is situated, because you have gone and seen the property. And where this land is situated, what is the present demand for this type of land in the area? How is the access? That is another important thing. How can you reach the property? Well, sometimes for some properties, there may be more than one access. This way also you can go, that way also you can go. Directly without any hindrance, you can go to the property. And you must mention all these things. And also you must say this land is free of any encumbrances. You have to mention. This land is free, any encumbrances. And you must obtain the local authorities' necessary reports regarding this land. You must obtain the local authorities, all the relevant reports and everything regarding this property. So this way you have to evaluate the collateral, property, mortgage. And you must say, so this is obtained as a security against the long-term facility. So long-term facility is matched with the property mortgage of a land and building. You have to mention. Similarly, machineries, mortgage of machineries. So you must give the details of the machinery. What are the names of the machinery? Whether it is a new machinery, old machinery, how is the technical condition of the machinery? Whether this machinery has the secondary value, second-hand value. All these information, when you take the machineries as the mortgage of machineries as a collateral, you have to describe the machineries. Whether these machineries, there are certain machineries. Some printing machines, those say even the German printing machines, they are more than about 25, 30 years, but still they are in demand. Very hardworking machineries, yes. So type of the machineries, whether the second-hand value, whether that can be sold second-hand, the technical status of the machinery, when you take. So those things you have to mention. And then the stock, mortgage of stock, you must maintain, discuss about the stock. So this is the evaluation of the collateral and its suitability. Vehicles, mortgage of vehicle, what type of vehicle, whether secondary value, second-hand value, whether the technical condition of the vehicle is in good condition, whether it is maintained properly. In the case of machinery also, whether the machines are maintained properly. The machineries and vehicles and stock mortgage are the collateral for the medium-term loans. So this is matching. So the evaluation of collaterals and its suitability, you have to mention. And then next item, profitability to the bank. Actually, whether this proposal, credit proposal, this facility is profitable to the bank. Otherwise, if it is not profitable, no point of granting the facility. So you have to mention. So for that one, you must take what is the cost of fund. What is the cost of fund you are using for this? From your treasuries department or management information department, you can get the cost of funds. What is the cost of fund? What is the interest rate you are charging? What is the margin you have? So how is the profitability by granting this facility? So you have to give the profitability to the bank by granting this facility. You have to mention. And then the risk analysis and the risk mitigation factors. What is the risk analysis? So what are the risks you are foreseeing? What are the risks you are foreseeing? And how to look how you can mitigate the risk. So while doing this one, so what sort of risk you can foresee by way of environmental risk or then management risk, financial risk. These are various risks we have already discussed. So based on that one, the hazards. What are the hazards? So what are the safeguard risk mitigation factors? What are the risk mitigation factors? And then what are the risk mitigation factors? And then special conditions for this facility. So what are the special conditions you are going to you want to give it for this? There are so many things you can special condition which we have already mentioned. And then do some examples, special condition. The company should not borrow from any other banks. Should not borrow from any other banks. And directors' payment will be, yes, the withdrawal should be curtailed. Similarly, various other general conditions, special conditions you have to mention. Periodical reports should be submitted to the bank. Periodical reports should be submitted to the bank. Whatever the special condition you foresee, you have to mention. But some condition we have already mentioned. That is, without signing the loan, the facility will not be released before. No, facility will be released only after signing the letter of offer and only after executing the security documents. All those things we have already mentioned. So similarly, any other special condition, if you think you have to include. And finally, the recommendation. Some people just say, in view of the above, we recommend the facility. In view of the above, we recommend the facility. That is not enough. Really, why are you ready? We recommend this facility for the following reason. One, this is important to the country's economy. It contributes to the country's economy. By way of, what are the ways? By way of contribute. Two, it creates employment. Then it has a very good management. It has a very good management. It is a need of the country in the present context. So various things. So you think what are the things important for this recommendation? So you list it. Instead of that one, some people they say, in view of the above, we recommend this. No, you must say why you are recommend this. 1, 2, 3, 4, 5. You must give the reasons why are you recommend this facility. So this way you have to prepare the credit appraisal and approving memorandum. Once again, I am running through. So your appraisal and approving memorandum should have credit limit summary that we have seen in detail. But one thing, when you go for more and more trade finance facility, it will be more complicated. That you have to learn yourself. In case of importing raw materials, what are the facilities you have going to? So there, of course, you have to think about the cash cycle, working capital cycle, how often the customer has to import, depending on the cash cycle or the working capital cycle, how often the customer has to import the raw material. So the LC facilities and the credit facilities to retire the bills, all these things. Such a way you have to prepare. Similarly, if the customer is exporting, then the export facilities, packing credit facility, pre-shipment or post-shipment facilities. So import, of course, to retire the bill. There are various facilities, credit facilities you have. You can give a hypothecation. You can give a revolving credit facility. You can give a pledge facility. You can give a TR facility. So depending on that. So that, of course, you have to practice on your own. You take some example. I have given you a very simple example for you to understand. For you to understand a very simple example I have given. So, depending on based on that one, you have to build up your knowledge. Especially the trade finance facilities. Somewhat complicated trade finance facilities for import or for export. You have to prepare. Okay, credit limit summary. Basic information sheet about the applicant, associate concern and their relationship, the insurance of the project assets, background, current status, and competition faced by the company and its strength, how they will overcome the competition, the company's strength, then the financial condition. This, of course, you have already learned everything. Profitability ratios, liquidity ratios, leverage, debt equity ratio, leverage, debt equity ratio, then debt or interest cover ratio, and comments under each item. You have to give your observation and comments. Then the evaluation of collaterals and its suitability. This, of course, our people, they generally they don't give a sound collateral examination. So when you mention the collateral, you must describe the collateral. It may be a property, land and building. It may be machinery. It may be vehicle. It may be stock in trade. It may be stock. So these are various types of collateral. Apart from the personal guarantee or the corporate guarantee or whatever it is, directed guarantee. So these things, of course, you have to describe. In the case of land and building, yes, that is immovable. You must describe, identify the property. Yes, that is the appropriate word. You must identify the property by the survey plan. So you must identify the property by the survey plan. You must give the name of the property, its extent, where it is situated, that is address. In the survey plan, how it is, what is the survey plan number? What is the lot number in the survey plan? Who prepared the survey plan? What is the date of the survey plan? We have to mention. And then value of the property. What is the market value? What is the for sale value? If there is a building, what is the reinstatement or insurance value? Who has valued it? Your panel valuer. His name. The collateral. And you must justify this collateral. This is a property, land and building against the long-term facility. So that is matching. So long-term facilities would be already covered by this collateral of a long-term standing. So you are covering that. Then the machineries. What are the types of machinery? What is the name of the machinery? There may be the numbers for the machineries. Whether the technical condition of the machinery, whether the machinery has a second-hand value, how the machinery is useful for the industry, then what is the value? This is also market value and the for sale value. Market value, the for sale value of the machinery. Who has valued it? The date of valuation. In the vehicle, condition of the vehicle, type of the vehicle, that is what is the make of the vehicle, whether that vehicle has a second-hand value in the market, technical condition of the vehicle, and value of the vehicle. What is the market value? What is the for sale value? Who has valued it? And then the stock in trade or the stock. the stock. What type of stock? What type of stock? Describe the stock. What is the on your way? What is the value of the current stock value from the stock card? So these are the values and the description of the you have to give. So that is evaluation of collateral and its suitability. Then profitability to the bank. So you must do some calculation. What is the interest rate you are going to charge from the customer? If the full amount is released, what will be the income to the bank? What is the cost of fund? What is the margin available for the bank? So what is the profitability to the bank you have to give? So it is a profitable. Granting this facility is profitable to the bank. You have to show it. And then risk analysis and risk mitigation factors. So what are the risks you can see? What are the risks you are anticipating? How you are covering the risk, mitigating the risk. As I explained earlier, hazards and safeguards. In addition, mortgage of these properties, insurance cover, all those things. Taking the insurance cover, mortgage of these properties, again the facility, yes. And the special condition. What are the special conditions to grant this facility? See, what are the special conditions you are proposing to grant this facility? And finally, the recommendation, you won't just say, in view of the above, we recommend. No, not that way. You must give the reason. This is a profitable venture. This is, of course, important to the country, economic contribution, employment creation. In the present situation, this is all these things, whatever the important thing, you have to give it. Your recommendation. And finally, you are giving. So once again, this will be very concise. The credit appraisal and approving memorandum should be very concise and give the important, relevant facts to the superior who is going to approve this facility under his delegated authority. For him to see the project through your credit appraisal and approving memorandum. He won't just go and see the project. No, he is seeing the project through your memorandum. Okay. Thank you very much. We will conclude this lecture now. If you have any questions, you can ask me.